Good morning. This is Manu Alia from Continuum Global Asset Management on July the 30th, bringing you the market commentary. This morning, one of the most important variables known as gross domestic product, which we all were waiting for, came out with pretty impressive numbers in my mind. The US GDP grew at about 2.4% on an annualized basis for the second quarter, after growing at about 3.7% for Q1. Even though these numbers in my mind were pretty impressive, the market really didn't react well and lost about 100 points right at the outset. Eventually, the market started to gain back some of those lost numbers, but why this happened is something that triggered a thought process in my mind, which I'd like to share with my viewers. Before I go ahead and talk about a specific variable, which will be very appropriate here, I think it would be prudent to talk just very briefly about the two main asset classes investors gravitate between, and we all know that are comprised of either debt or equity. The only two things that we can do is either we can loan money to somebody or we can take an equity position in a company or whatever product we have. Everything else in this world is an offshoot of either debt or equity. Having said that, investors behave on a spectrum of safety and growth based on, I believe, conventional wisdom. Most of us just follow the trend, and conventionally, debt is supposed to be a lot more safe than equities. So in times of turmoil, in times of uncertainty and fear, we just naturally start to gravitate towards bonds or what we call safe income producing securities. Well, if you look at statistics, back in October, November, and December of '08, the markets were going through extreme fear. The numbers show us how fearful the markets were. And if you look at the 1 month treasury, the 30-day treasury, it was yielding only about 0.01%. During December of '08, the 10-year treasury was yielding about 2.6, 2.7%. The reason the yield were so low is because people were gravitating towards treasuries and buying treasuries, hence increasing the prices of the treasuries and lowering the yields. Well, a lot has changed since the third and the fourth quarter of '08. Currently, the 10-year treasury is yielding about 3.4, 3.5, and it fluctuates on a daily basis. But the differential between the corporate bonds back in 2008 as opposed to today is an entirely different situation. Back in December of 2008, an investment grade bond, corporate bond, was yielding about 8 to 9% more than the US Treasury. In other words, people were so scared of corporate debt. Everybody was of the thought process that the world is coming to an end, and the average yield on a triple B rated US corporate bond was about 11 or 12%. Today, as a matter of fact, I read an article this morning in the Wall Street Journal that McDonald's and another company known as Duke Energy raised about $500 million each at an average yield of about 3.5 to 3.7%. Now think about it. In other words, people who are buying these bonds or loaning the money to McDonald's and Duke Energy believe that these companies are pretty safe, almost as safe as the US Treasury. So what has happened over the last, I would say, year and a half, 18 months is that the confidence level has really increased despite the fact that we've seen a 21 to 23% gain in the broad-based indices. So the bottom line is that investors are feeling a lot more comfortable with the economy and the future of the US and global growth. What I would like to urge to investors and viewers is, depending upon their own objectives and time horizons, and like I always say, all the disclaimers about uniqueness of each and every individual investor, I would urge you to look at dividend paying stocks as opposed to uh, yielding companies, because you're looking at McDonald's or you're looking at AT&T. Either you can go out and buy their debt, or you can go out and buy their equity, which is paying a 6-7% dividend. If you look at companies like Altria, symbol is MO, or AT&T, symbol is T, or Verizon, symbol is VZ, they're all paying a dividend yield of about 6.5 to 6.7%. Now, one can go out and buy a bond which pays a 4.5% dividend debt yield, or you can think about buying a stock of companies like I just mentioned and say, okay, if I can yield 6 to 6.5% dividend yield, I can make another 3 to 4% on an average and do an average return of 8, 9, maybe 10% from solid, strong companies like that. So the point is, the numbers do tell us that there is increased confidence in the economy and the consumer behavior, but the whipsawing of the market makes us feel differently. Again, I would urge people to take a little bit of a macro, longer term view and look at the numbers as opposed to the market movement on a daily basis. Again, if you'd like to discuss this in detail or have any comments or questions, please feel free to give us a call. You can get all our contact information and previous market commentaries at www.cgamadvisor.com. Once again, that's www.cgamadvisor.com. Once again, thank you for listening and happy trading.